There is a contract millions of Americans sign before they are old enough to understand what they are agreeing to. No collateral required, no credit history needed, no questions about the future. Just a signature, a promise to pay, and a belief that everything will work out. By the time most people realize what they signed, it is already too late to undo it. The United States is now carrying over $1.7 trillion in student loan debt. That is more than all the credit card debt in the country combined. And yet, every year, another million students walk through the same doors, sign the same forms, and take on the same burden. Not because they are naive, because the system was built to make this feel like the only option. You probably know this feeling. You were 17 or 18 years old when the conversation started. Everyone around you, your parents, your teachers, your school counselors, told you the same thing. Go to college, get a degree, get a good job. The path was presented as obvious, as safe, as the responsible thing to do. And maybe you believed it. Maybe you filled out the FAFSA, accepted the financial aid package, and signed the promissory note without fully understanding what any of it meant. Because why would you question it? This is what everyone does. But here is what the brochures never showed you. The average cost of a 4-year college education in the United States today is over $100,000. At a private university, that number can exceed $200,000. Even at a state school, tuition has risen by more than 180% since 1980, far outpacing wages, inflation, and virtually every other cost in the economy. And while costs were climbing, wages for entry-level workers were barely moving. The result is a generation that took on enormous debt to compete for jobs that don't pay enough to repay it. People in their 20s and 30s who are not behind on their bills because they are irresponsible. They are behind because the math never worked to begin with. Here is the thing that most conversations about student debt miss. This is not just a story about rising prices. It is a story about how risk was quietly transferred from institutions to individuals. Universities raised tuition because the money was available. Lenders offered loans because the debt could not be discharged in bankruptcy. And the government backed the whole system because it needed a story about opportunity. The cost of entering the middle class was placed on the shoulders of the people who could least afford to carry it. And it was all made to look like a personal choice. To understand how this plays out in real life, consider Chloe. Chloe grew up in a working-class family in Pittsburgh, Pennsylvania. Her parents did not go to college. Her father worked in construction. Her mother worked part-time at a school cafeteria. They could not pay for her education, but they believed in it completely. Chloe was a good student. She worked hard. She got into a well-regarded state university. She borrowed $47,000 to pay for it. That was the responsible amount. That was below average for a 4-year degree. She graduated with a degree in communications and found a job at a marketing agency. Starting salary, $38,000 a year. Her monthly student loan payment, on a standard 10-year repayment plan, came to $490 a month. Her rent, $1,050. Her car and insurance, $380. Groceries, utilities, phone, $500. At the end of every month, Chloe had almost nothing left. Some months, she had exactly nothing. She was not spending recklessly. She was not living large. She was paying the minimum cost of adult life in America, and it consumed everything she had. This is the first rule the system never tells you. Interest does not care about your circumstances. Chloe's $47,000 in loans did not sit still while she built her career. The moment she left school, interest began accumulating. Federal student loans today carry interest rates between 5 and 8%. On a $47,000 balance, That is hundreds of dollars every single month before she pays down a single dollar of principal. In the first years of repayment, most of her monthly payment goes straight to interest. The principal barely moves. This is how a $47,000 debt becomes a $60,000 debt, even when you make every payment on time. And for borrowers who defer their loans, who pause payments because they cannot afford them, the balance grows even faster. This is called negative amortization, and it is legal. It is built into the structure of the loan. There is a reason student debt is the only form of consumer debt in America that cannot be wiped out in bankruptcy. In 1978, Congress made it nearly impossible to discharge student loans through bankruptcy. They did this to protect lenders, not borrowers. The risk was designed to flow in one direction. And once you understand that, the entire architecture of the system becomes visible. The second rule is this: the degree guarantees nothing. This is the promise that made the whole system work. Go to college, get a degree, and the doors of the economy will open for you. For a generation, that was roughly true. In the 1970s and 1980s, a college degree reliably led to a stable, well-paying career. The premium was real. But then something shifted. As more people went to college, employers began requiring degrees for jobs that had never required them before. This is called credential inflation. A warehouse manager now needs a bachelor's degree. A dental receptionist now needs a bachelor's degree. The degree stopped being a signal of rare capability. It became a baseline requirement for entry. And yet the price of that credential kept rising. Chloe's communications degree cost her $47,000. The job it unlocked paid $38,000 a year. The math is not a personal failure. It is a structural one. A study by the Federal Reserve Bank of New York found that roughly 40% of recent college graduates are working in jobs that do not require a college degree. 40%. They borrowed the money. They earned the credential. And the economy handed them a job that didn't need either. The promise of the degree was not a lie, exactly. It was a bet. And for millions of people, the bet lost. So how did it get this way? The answer begins in 1965. That year, Congress passed the Higher Education Act, which created the Federal Student Loan Program. The idea was generous: make college accessible to people who could not afford to pay up front. But the program had a structural flaw baked into it from the start. Federal money flowed to universities based on enrollment. The more students enrolled, the more money universities received. This created a simple incentive: grow enrollment, raise tuition, and let the government-backed loans cover the difference. Universities did exactly that. Between 1980 and 2020, the cost of a 4-year college education rose by more than 3 times the rate of inflation. Administrator salaries grew, campus buildings expanded, athletic facilities multiplied, and students paid for all of it. Not out of savings, out of debt. The system worked beautifully for universities, for lenders, and for the government, which collected interest on trillions in outstanding loans. For students, it worked like this. You paid for someone else's expansion with your financial future, and you called it an investment in yourself. Here is what makes this system truly insidious. It disproportionately affects the people it was designed to help. The students who borrow the most are not the wealthy ones. The wealthy ones have parents who can pay tuition in cash, or who can co-sign private loans at favorable rates, or whose family connections lead to jobs regardless of credentials. The students who borrow the most are the first-generation students, the students from working-class families, the students for whom college was the only available path towards something better. These are the students who take on $50,000, $80,000, $100,000 in debt. and then graduate into a labor market that offers them $35,000 or $40,000 to start. The debt follows them through their 30s and 40s. It shapes where they can afford to live, whether they can save for retirement, whether they can afford to have children, whether they can take risks, start businesses, or buy homes. Chloe is 31 now. She has been making payments for 8 years. Her balance is $41,000. She has paid $47,000 in total, nearly her entire original loan, and still owes almost as much as she borrowed. She is not unusual. She is the median. We tell young people that education is the path to opportunity, and in some fundamental way, that is still true. Knowledge matters. Skills matter. The ability to think critically and work effectively. These things still carry real value. But somewhere along the way, the idea of education was separated from its purpose. It became a product that universities competed to sell at higher and higher prices. A product that lenders competed to finance with riskier and riskier terms. And a product that millions of people were told they had no choice but to buy. Because in a society that requires a degree to enter the middle class, refusing to borrow is not a form of freedom. It is just a different kind of trap. The student debt crisis is not a story about irresponsible borrowers. It is a story about a system that shifted the cost of economic participation onto the people least equipped to carry it, and then told them to be grateful for the opportunity. The question is not whether a degree is worth it. The question is, who decided it should cost this much? And who benefits from the answer?